Welcome to episode 23 of the Tax Smart Daily, a daily video series teaching real estate investors how to be tax smart. I'm Brandon Hall, and before we get started, I invite you to subscribe to this YouTube channel. I don't want you to miss any future videos that we drop. We have a daily video series, we have a podcast, a live Q&A, all sorts of good stuff. Also, join our Tax Smart Facebook group and our Tax Smart newsletter. Links to both of those are in the description of this video. Lastly, if you have any questions or if anything that I say resonates with you, drop me a comment. I really appreciate the folks that take 10 to 15 seconds out of their day to engage with me. Keeps bringing me back to the table. You guys are my oxygen, so thank you so much. Today's topic is about the progressive tax rate system that we have. And it comes out of our Facebook group, the Tax Smart Real Estate Investor Facebook group, in the form of a question. The question was, how can I eliminate my federal taxes? And we went through like, well, here's how you do it. But then I posed a counter question and I asked, why would you want to reduce your federal taxes down to $0, right? Why do I want to eliminate? Because that might not always be the best thing or the smartest move. And the reason for that is that we have a progressive tax system here in the United States. And what that means is that if I earn $100,000, not all of the $100,000 is going to be taxed at a 24% tax rate. The first X dollars is going to be taxed at a 10% tax rate. The next Y dollars is going to be taxed at a 12% tax rate. The next Z dollars is going to be taxed at a 22% tax rate. And yes, I have all the tax rates right here, and that's why my eyes are darting over to it. So the question becomes, if I'm in the 24% tax rate, let's say that I'm married filing joint. And I earn $326,000. That's my taxable income, right? So I actually earn more than that, but after my standard deduction or itemized deductions, after my 401k contributions, I'm down to $326K. If I'm at $326K, I am in the 24% tax bracket. That means that if I earn one additional dollar, that additional dollar is taxed at a 24% tax rate. If I earn one additional dollar less, then I save myself 24 cents, right? So every dollar in that bracket is taxed at 24%. But if I'm able to drop my income down to $171,000, and that's for married filing joint, now I'm in the 22% tax rate. So now each additional dollar that I earn up to $171,000 is taxed at 22%. Over $171,000, now it's taxed at 24% all the way up to $326,000. So the tax rates only apply to each additional dollar that you earn while you're in that specific tax bracket. So what happens is people look at their taxes and they say, oh, I hate paying taxes. How can I eliminate this? But I always like to pose the question of, are you sure that you want to eliminate it? Because if I'm in the $326,000 tax bracket, then that would be a huge tax bracket. I earn $326,000 married filing joint. I'm in the 24% tax bracket. Every dollar of loss that I am able to generate for about $150K worth of loss, every dollar of loss saves me 24 cents. Pretty good, right? But then if I'm able to generate that $150,000 of loss, now I'm going to drop into the 22% tax bracket. So any additional dollar of loss that I generate now only saves me 22%. Then if I'm able to save another if I'm able to generate another $90,000 loss, now I'm going to drop into the 12% tax bracket. So now every additional dollar of loss that I generate only yields 12 cents of savings. And if we look at this on the flip side, let's say that I earn $450,000. That's going to put me, let's say that I earn $400,000. That's going to put me in the 32% tax bracket. Now, if I'm married filing joint. Now, we just said $326,000. That's the 24% tax bracket. That's the high end of that tax bracket. So once I get over that, now I'm in the 32% tax bracket. The 32% tax bracket for married filing joint runs from $326K all the way up to $414K. So if I earn $400,000, I'm in the 32% tax bracket. And I can take $74,000 of loss and save 32 cents on the dollar for every dollar of that $74,000 loss. But if I take $75,000 of loss, then the first $74,000 of loss saves me 32 cents. but the remaining $1,000 of loss saves me 24 cents. Because at 400,000, when I take $74,000 of loss, I come right down to the 326K cap for that transition from the 24 to the 32% tax bracket. So I'm right there. So every dollar of my $74,000 loss saves me 32 cents in taxes. But if I take a $75,000 loss, that extra $1,000 actually drops me into the 24% tax bracket. And it doesn't mean that my entire 74K of loss is only saving me 24 cents. It just means that the additional $1,000, so the first 74,000 saves me 32 cents. That additional 1,000, which is now in the lower tax bracket, only saves me 24 cents. So the real question is, do you want to drive so much loss in 1 year that you're saving, that you go from maybe saving 32, 24, 22 cents on the dollar down to 12 cents, down to 10 cents. So you really got to watch your marginal tax rates. You got to watch your tax brackets to make sure that you're optimizing, because, we might tell you it might be smarter to try to spread that loss out. And you can spread these losses out by making timing decisions on your cost segregation studies, your acquisitions. So there are ways to spread out the realization of these rental losses, or the recognition of these rental losses, on your taxes. And you want to be thinking about the timing of that, because we might not necessarily want to spike any 1 year with incredible losses to drive us all the way down to $0, because along the way, while we saved 32 cents and then 24 cents and then 22 cents, our loss value kind of erodes when we get down to that 12% tax bracket and the 10% tax bracket. So really important to understand that the progressive tax rate system here in the United States means that each additional dollar of income is taxed at whatever bracket you're in. It's not that all of your income is taxed at whatever bracket you're in. It's each additional dollar. Once you trip those thresholds, each additional dollar of income is taxed at that tax bracket. And that's why people in the 37% tax bracket are often cited as only paying like 21 cents. That's the effective tax rate, right? So maybe on all of their income, they pay 21% of that on average in taxes. Well, it doesn't mean that they only paid 21%. They paid at each one of these marginal tax brackets, but the total tax compared to their total income, that's your effective tax rate, and that is different than your marginal tax rate. So that's kind of the average of what you paid when you compare it to your total income. So I hope that this helps. Big takeaway here is just think about the timing of loss recognition as it pertains to rental real estate losses. And remember, you do have to make those rental losses, in most cases, non-passive in order to claim the losses against your other income. So make sure that you watch our other videos on how exactly you can do that. But thanks so much for watching today's video of the Tax Smart Daily. Please check out the links in the description to this video to join us in our various communities online. We'd love to have you in that Facebook group. We'll see you tomorrow.